The fundamental decision for new investors often revolves around how to approach the complex landscape of financial markets. Should one actively seek to outperform broad market benchmarks, relying on skilled judgment, or simply track them, embracing the market's collective wisdom? This critical choice, between active and passive investing, profoundly dictates an investor's strategy, cost structure, and potential long-term outcomes, presenting a significant dilemma for effective capital allocation from the outset. Every investor's core objective is the prudent appreciation of capital, aiming to protect purchasing power against inflation and achieve specific long-term financial goals, such as retirement or large purchases. However, the methodologies employed to realize these aims diverge significantly, creating a broad spectrum of investment approaches, each presenting inherent trade-offs, efficiencies, and levels of engagement. Understanding these foundational differences is absolutely paramount before committing any capital. Active investing represents a strategy where a dedicated portfolio manager or an individual investor endeavors to generate returns that consistently exceed those of a specific, predetermined market benchmark. This approach is firmly predicated on the belief that through diligent research, insightful analysis, and timely execution, it is possible to identify mispriced securities or effectively capitalize on perceived market inefficiencies that others overlook. Fund managers engaging in active strategies typically conduct extensive and continuous research. This involves both fundamental analysis, scrutinizing a company's financial health and intrinsic value, and technical analysis, studying price trends and trading volumes. Their goal is to select individual stocks, bonds, or other assets that are expected to outperform the broader market. They may also attempt to time market movements, aiming to buy assets when prices are low and sell when they are high, or concentrate holdings in specific sectors anticipated to show superior future performance, requiring constant vigilance and reevaluation. The primary advantage, and indeed the allure, of active management is the potential for superior returns, often referred to as alpha, should the manager's expertise and strategic decisions prove consistently effective in identifying undervalued assets or skillfully avoiding overvalued ones. For investors, this offers the compelling possibility of achieving financial growth significantly beyond what the general market provides, theoretically accelerating wealth accumulation and reaching financial objectives more rapidly. However, achieving consistent outperformance presents a formidable and often elusive challenge. Active funds typically incur substantially higher operating expenses, stemming from extensive research costs, frequent trading commissions, and elevated management fees, all of which directly and incrementally erode net returns for the investor. Empirical evidence, compiled over decades, frequently indicates that a substantial majority of actively managed funds fail to consistently beat their chosen benchmarks over extended periods, especially after accounting for these significant costs and tax implications. In stark contrast, passive investing, widely known as index investing, adopts a fundamentally different philosophy. It aims to precisely replicate the performance of a specific, broad market index. Instead of attempting the difficult feat of outperforming the market, the core goal is simply to mirror its returns, thereby accepting the average market performance rather than seeking to actively exceed it. This strategy is largely built upon the premise of efficient market hypothesis, which posits that consistently beating the market is exceptionally difficult due because all available information is already reflected in asset prices. Passive strategies are typically implemented through widely accessible financial instruments such as index funds or exchange-traded funds, ETFs. These vehicles are meticulously designed to hold a diversified basket of securities that precisely track an underlying index, for instance, the S&P 500 for large-cap U.S. equities or a broad global bond index. The investment manager's role in a passive fund is primarily to maintain the portfolio's precise alignment with the chosen benchmark, requiring minimal discretionary decision-making, trading, or subjective asset selection, thereby streamlining the operational process. The main advantages of passive investing include significantly lower expense ratios, a direct consequence of reduced research, minimal trading activity, and automated management processes. Furthermore, passive funds inherently offer broad diversification by holding numerous securities across an entire index, which substantially reduces idiosyncratic, single-asset risk. This inherent simplicity translates into less time commitment, lower ongoing vigilance, and a reduced cognitive load for the individual investor, making it highly appealing for those seeking a straightforward, hands-off approach. Despite its numerous benefits, passive investing inherently does not offer any opportunity for outperforming the market. Investors in passive funds are, by definition, exposed to the full spectrum of market movements, meaning they will mirror any downturns and corresponding losses experienced by the underlying index without any active mitigation strategies. During periods of significant market contraction or recession, passive investors will experience the full, unbuffered impact of these negative market forces on their portfolios. Decades of rigorous financial research, notably from influential academics like Eugene Fama, Kenneth French, and John Bogle, have consistently highlighted the systemic difficulty active managers face in consistently delivering alpha. Studies across various asset classes and timeframes often demonstrate that, after accounting for fees, trading costs, and taxes, passively managed index funds frequently outperform a substantial majority of actively managed funds over long investment horizons, thereby reinforcing the efficient market hypothesis and the power of low-cost diversification. The strategic choice between active and passive investment approaches often hinges critically on an individual's personal risk tolerance and psychological disposition. Active investing inherently appeals more to those investors willing to accept higher idiosyncratic risk in fervent pursuit of potentially greater returns, fueled by a belief in a manager's superior skill or their own analytical prowess. Conversely, passive investing typically suits individuals who prioritize broad market exposure, consistent, albeit average, returns, and a generally lower portfolio volatility, valuing predictability and reduced behavioral biases. An investor's specific time horizon and level of financial knowledge also play crucial roles in this decision-making process. Long-term investors, particularly those with less available time for market analysis or limited expertise, often find passive strategies more suitable due to their inherent set-and-forget nature and significantly lower ongoing costs. Conversely, shorter-term investors or those possessing deep market knowledge, coupled with a strong conviction in their ability to select winning assets, might gravitate towards a more active approach, though this path undeniably demands substantial dedication, continuous research, and emotional discipline. Ultimately, the optimal selection between active and passive investing is not a binary choice, nor is it a universally applicable, one-size-fits-all solution. Many astute investors adopt a pragmatic hybrid approach, strategically combining core passive holdings, which provide broad market exposure and cost efficiency, with a smaller, tactical allocation to actively managed funds or carefully selected individual securities. The truly optimal investment strategy is one meticulously aligned with an investor's specific financial objectives, their realistic risk capacity, personal time commitment, and evolving financial situation.